non-QM business is supposed to more than double in 2018, so you want to get a piece of that action, and we can help you out. We're doing a webinar with Angel Oak on December 14th. We're going to show you how these products work, and most importantly, how to go find that business to supplement your pipeline. Want to check it out? I'm sure you do. Click the banner you see right here, over on your right, or if you're watching us on Facebook, there's a link up above.
You guys remember all this stuff in the build up to Dodd-Frank? You know, people saying, if you want a bank loan, you better have skin in the game, exclaimed the regulators. What I'm most proud of is the skin in the game provision, claimed the bill's author, Barney Frank. Now, everybody said the biggest reason that we had a mortgage and economic meltdown is because borrowers had no skin in the game.
Stick your hand right out and shout, give me some skin, my friend.
So we fixed it. We cured the problem, and now everybody can take a deep breath. Woo! Wait, or can we?
That's because Flagstar is now offering 100% loan-to-value deals with 3% for closing costs to low to moderate income borrowers. So, broke people can get into a home with no skin in the game. Like nothing. Not even closing costs, let alone the down payment.
So, we're back to doing stupid again?
Oh yeah, it's happening.
Now this is where it gets kind of funny, guys. The 3% down towards your closing costs, all right, you don't have to pay that back, but you're going to get a 1099 because the IRS, they always want their cut, now don't they? So I guess the skin of the game is the tax that you're going to have to pay on this.
And let's not forget that this is only available to the highest risk profile borrowers, people that don't have any cash. I mean, it's worth pointing out that Fifth Third Bank is about to do the same thing, but in a bunch of states. Now, Flagstar is only in certain areas of Michigan that they're making these loans. So let's review.
Due to the cost of increased regulation, many smaller mortgage companies have gotten out of the game and been absorbed by bigger banks, thus making banks bigger. New bank formations have stopped, meaning fewer, bigger banks. Dodd-Frank says we can only bail out systematically important institutions. That's code for big banks. And now we're cheering no skin in the game loans. So, 1 decade out, we have fewer, bigger banks with a guarantee to get bailed out in writing with no skin in the game loans, but only to the pools of loans with the highest default rates.
So, whoa, here's the thing. Believe us, all right? Thing is, we like these loans, man. I mean, if you've seen some of the suburbs of Detroit, what else are you gonna do, man? And payments are cheaper than rent, and owning helps all neighborhoods, so we're in.
What we don't like is how the government has picked and chosen what's a good 100% LTV finance deal and what's not. For instance, the FHA Sapphire program was roundly bashed by everyone, including the Mortgage Bankers Association. I believe the DOJ actually sent a threatening letter saying they were going to sue HUD. Now, that was just a 100% loan-to-value deal with closing costs. That, by the way, was entirely subsidized without any taxpayer money. That's bad. But this one with Flagstar is using community redevelopment money, which is taxpayer money, and this one's good? I mean, from my vantage point, it makes no sense because there's no consistency here, guys.
And think about this. Why only offer it to low to mod income borrowers? I mean, I don't get it. Because if the loan's a good idea, then shouldn't it be available to everybody? I mean, if you don't expect massive foreclosures, shouldn't I be able to get one? I mean, why only low to moderate income? Why not everybody? The answer is simple. Because they know the foreclosure rate is going to be off the charts and we can't afford massive foreclosures across the board. Massive national foreclosures, that is. Now think about it. There can't be any other reason, right?
It's kind of like going out to lunch and they have specials. If it was really that special, wouldn't it just be on the menu, right? I mean, there's got to be something wrong with it. Anyways, so we offer a super risky loan, a no skin in the game whatsoever loan to the highest risk profiled borrowers, knowing full well it's going to be bumpy. Have we ever thought maybe it's these types of policies that ensure broken communities remain broken? I mean, hey, history tells me this loan's not going to perform. So how many would you like?
Same activity over and over again, same outcome over and over again. It's crazy, right? That's what they say.
But I mean, we get it. It's the inconsistencies that really drive us nuts. Now, you know what the problem is? They underwrite these programs as if the borrower has the same amount of disposable income as a standard loan. For example, if you have a 42 back-end ratio and you make $28,000 a year, you have a lot less money at the end of the month than someone who has the same 42 back-end ratio and makes $90,000 per year.
I mean, you know, your roof goes bad or your HVAC goes out. Are you gonna have the money to take care of that? Or are we just going back down the road of neglected home maintenance again?
And if you've seen some of the houses that they're going to be selling in some of these suburbs in Detroit, I'm telling you guys, they weren't built last year.
However, like we said, if the program is good, then offer it to everybody. If the loan to value is sound, then open it up to other programs. Then other lenders can participate.
Limit the ratios so we can give these folks a fighting chance. And lastly, make sure the home's in above minimum standard condition. I have $300 left over at the end of the month. I need to put a $5,000 roof on.
Yeah, it's not gonna work.
It's problematic. It's just not well thought out. I feel like we've deja vu.
It is deja vu. But, you know, if you're over at Flagstar and you know all the details on this product, we'd love to see them in the comments down below. I'm sure everybody else would too, because it's interesting that it's out there. I mean, it's only inevitable. These things are going to come once again.
Well,
here they are.
You know, and we sound like we're being Debbie Downers about it, and it's because of the inconsistent nature of all of this stuff and how everybody grandstanded 9 years ago. But this fundamentally is a good idea, because you see some of these suburbs, I mean, really, what are you going to do?
Yeah.
You know, get people in these houses, put them in a good position, you know, pride of home ownership and try to turn these neighborhoods around. I get where it's coming from, but the foreclosures will happen.
You know, this time around, though, I'm sure the focus will be ability to repay with these guys. Let's hope so anyway. You know, let's hope so. We'll learn more as it comes out. You guys have a great day. Forward, share, and subscribe. Leave us your comments down below, and we'll catch you later here at the National Real Estate Post.
I wonder if they ever fix the water in Flint.
I haven't heard.
I wonder if they still do Devil's Night in Michigan.
Oh, for Halloween?
Yeah.
I don't know.
All right.
See ya.
Bye.